we've got a big inflation problem around the world to get inflation under control.
National debt owed by the taxpayers kept going this way. That debt is going to kill us. Because they want to destroy hegemony of the U.S. dollar, which came in place in 1944 with Bretton Woods. The dollar became the gold standard of the world, the reserve currency of the world. And then 1971, Nixon took us off the gold standard, and we went from being a capitalist state to a credit state. So everything is floating on debt right now.
Correct.
I think bonds are debt also. And so when Harry Dent is yelling about, you should buy U.S. Treasuries, I said, but I think they're going to torpedo the U.S. Treasury. And that's what we called you, Adam, is because what the hell is a bond? You know what I mean? How safe is it?
Let's start with explaining what bonds are, and then we'll get into are they a good place to be now or not? Because the answer is, it's a little bit nuanced, and it's a sense of like something that might have that might not be something good to be in the long term, might be something good to be in the near term, and I can explain why a little bit later in the conversation. But let's start with sort of what is a bond, right? Let me contrast it with what's an equity or a stock, because I think people understand that really easily. A stock is basically just a share of ownership in something, right? I can go buy a share of Apple. It's clear I don't own all of Apple Corporation, but I own, some, I don't know how many shares Apple has outstanding, but let's assume it's 100 million. I have a 100 millionth claim in terms of the earnings that Apple owns and the assets that it has, right? I'm a part-time shareholder or fractional shareholder in this company. A bond is not ownership. A bond is an IOU, essentially, where you give your money to somebody and they say, okay, I'm going to pay you back, but for the risk that you're taking by giving me your money, I'm going to pay you some interest as well along the way. So it's basically just a contract, and it's just math. Bonds tend to be a little bit easier to deal with because when you're dealing with a stock, you have to take into account all sorts of things. Okay, what's the potential of this company to earn money over time, and what do I discount those earning streams back at, and what's their competition doing, and maybe they're going to take over their category, or maybe they're going to be outcompeted. Bonds, it's really just much more, okay, what's the math of this contract I've entered into with you? And then you have to factor in a little bit of default risk, right? Which is, okay, what's the likelihood this person's actually going to be able to deliver on what they're telling me they're going to do? If you are borrowing from the U.S. Treasury, that is considered, and we can debate this in a minute, but that's considered to be basically about the safest type of debt that you can take on. And one of the reasons why it's so safe is, first, the U.S. is the biggest, most stable player out there on a relative basis, but also we have a printing press. So if we really get in trouble, the Federal Reserve can basically print up the money to give to the Treasury to make sure that they pay you back. So, you are going to get paid back at least nominally, meaning if I give you $100, it's a high likelihood you're going to give me $100 back. Now, if they had to print those $100 to pay me back, then maybe those $100 are devalued a bit by inflation. But again, borrowing from the U.S. Treasury, relative basis, pretty darn safe. Borrowing from a company that's got what's called high yield debt, which is sort of the fancy way to say junk debt. And this is a company that maybe isn't profitable, maybe already has a lot of debt on its balance sheet. Its prospects don't look very good. First off, that debt is going to come you're going to demand a higher yield to borrow that debt, right? Or to buy that debt, because you don't trust their ability to pay you back as much. And so that's a riskier debt. So there's sort of a spectrum of bonds that are out there. Those that are considered to be very safe, or those that are considered to be very speculative. And basically it's the yield on the bonds that differ between the two. A more speculative bond should likely offer you a higher yield because that's making up for the higher risk.
Adam, so a longer-term bond, a government bond, usually would have a higher yield than a short-term bond, correct?
Great question. It usually should.
Yeah.
It doesn't right now in the U.S. Treasury market.
Yes. So could you talk about that for just a minute?
Sure. You may hear on the news people talk about an inverted yield curve.
Yes.
And that is exactly what you just discussed there, Kim, which is shorter-term bond yields are higher than longer-term bond yields. And first, you would expect higher-term bond yields to be higher to compensate you for the risk of getting paid back over a longer period of time, right? If you borrowed money from me and we're going to give it back to me tomorrow, well, my duration risk is pretty low. I'm going to get it back tomorrow. I'm not going to charge you all that much to borrow it overnight. If you want to borrow it for 30 years, I'm going to say, yeah, Kim, you're going to have to pay me more money because I'm basically giving you my money for a much longer period of time. When people when the bond market gets nervous about where things are headed and it thinks that something bad might happen in the relatively near term, that then pushes up those short-term interest rates. And so it's basically the bond market telling you, I think in 30 years, things are going to be back to normal. I think we're going to be okay in the long run, but I think we're going to have some rough times in the very near future. And that's why I'm going to demand a higher interest rate in the short term.
Yeah, so let me give you really simple. So you have a 5-year bond, let's say,
Yeah.
and you're getting paid 5%, whereas a long-term bond is paying 1%. That's an inversion, because it should be the other way. The longer-term bond should be paying 5%, but short-term is paying 1%. That's when the higher math kills me at that point. The shorter-term bond should be less interest, but today the shorter-term bonds are higher interest than the long-term bonds, and that's the inversion.
There are probably many factors for that inversion, but the two important things about it. One, an inverted yield curve is one of the most dependable signals we have of approaching recession. If you see an inverted yield curve like we have today, you should say, all right, look, I got to get prepared that we may be entering a pretty, material recession in the not too distant future, because whenever we've seen this before, it's happened. And right now, as you guys know well, we've got a big inflation problem around the world, but certainly in this country. Most central banks, definitely the Fed, are hiking rates right now to get inflation under control. Now, we have an economy that has gotten extremely used to, some would say addicted to or dependent on ultra low interest rates. That the Fed brought them down to, zero. It kept them really low, lower than they'd been in some cases in recorded history. And the system habituated to that. So now that rates are rising, they're rising pretty dramatically. Right, we've gone from near zero, now we're around 3%. We're going higher. The Fed is highly likely to hike another 75 basis points at their next meeting, and is talking about going even higher still. And we've raised rates faster than we ever have in the data series. So think about, the way I like to help people understand this is, let's say I gave you, Robert, a gallon of water, and I told you you had a week to drink it. You'd have no problem with that, right? But let's say I just shoved it up against your face and I just forced it down your throat all at once. You might actually choke and drown. Same amount of water, but it's the rate of change that's the different point there, right? So we're shocking the economy right now by bringing rates up to a point where the economy is not used to rates being this high, may actually not be able to function at rates this high. And we've done it in such a fast period of time that it's literally like shocking the financial system here.
So what has happened is that as interest rates kept coming down because they wanted people to borrow and stimulate the economy, our debt went this way. So as interest rates came down, the Fed not really borrowed, but printed more money, and our national debt owed by the taxpayers kept going this way. But the moment they raise interest rate, that debt is going to kill us because it's too expensive.
Exactly. The debt service payments all of a sudden become a lot more burdensome.
And who pays that? Our taxes. Who pays the debt? Are the U.S. taxpayer. So mom and pop get screwed again because they use that cash, the low interest rates, to bail out the banks that were in trouble in 2008. Things says all this is going up and down, and that's why I'm going, this is a little too tough for me because I have a simple little brain here. And the question is, because interest rates are going up, prices of gold and silver come down because everybody wants the higher interest rates than gold and silver will pay. So this whole thing just gyrates the entire world. So that's why you're here.